Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Where does Canada stand in the overall picture for growth? And to what extent are interest rates and interest rate policy, for that matter, crucial to growth in Canada's age of industrialization? The Bank of Canada held interest rates steady for a third consecutive time yesterday. At 2.7%, the central bank says the rate is at the midway point of its neutral range. As the growth of global hyperscalers roars ahead and the slowing down of sectors not linked to the AI supply chain in some way seems to unfold, can North American central bank policy play the pivotal role it once did in driving economic outcomes? Joining us here today to further discuss the Bank of Canada's latest rate decision and the scenarios around which it was made is former TD Bank Chief Economist Don Drummond. Don is also currently the Stauffer-Dunning Fellow at Queen's University and Fellow in Residence at the CD Howe Institute. Warm welcome to you, Don. Great to see you. Thanks for joining us.
Thank you very much.
Delighted to have you here. Don, I wonder if we can start with something that's been made much of, actually, in reaction to the central bank decision yesterday. No lowering of interest rates. There are reasons, there are scenarios, we'll get into them. But if we do see lower interest rates in the US or here, that often is pointing to something bad.
I've been doing a fair number of interviews recently, and everybody's just champing at the bit. Yeah, we want lower interest rates. And I would say, be careful what you ask for. We will get lower interest rates if and when there's evidence of a weakening of the economy. So if you got a job and you keep your job and you got a mortgage, yeah, go for it. Wish for lower interest rates. But for a lot of people, lower interest rates come as a byproduct of something happening bad in the economy. And the Bank of Canada acknowledged that the economy has weakened, the unemployment rate is still below 7%. It's not that bad. Underlying inflation pressures are at 3%. If those underlying pressures go down, it's probably because the economy is going to weaken further.
Right. Okay, that's interesting. And also, I want to get into some of those scenarios. Some of them have been well played out, but we'll go into that. There was a phrase in the press conference put to Tiff Macklem yesterday, the governor of the Bank of Canada. He had used it previously, but it was put back to him, this permanent scarring of the Canadian economy and where this is seen. He partially answered that by saying, yes, the Canadian economy will simply be less efficient. We're not selling cheaply across the border. There are going to be more costs involved. I wanted to sort of see what you thought of that permanent scarring, and if you could expand on how you see that playing out in the Canadian economy.
I'll start off as a stuffy economist on the technical side. We all use models to analyze this. Models are captivated by historical experience and historical data. You look at what was the reaction to something similar happen in the past. We have not seen really high tariff rates outside of the 1890s and the 1930s. And we have precious little data even to analyze that. And is it really relevant of 100 plus years ago what happened?
90s, right, okay.
Yeah, I mean, if you look at the average tariff rate in the United States in January of 2025, it was 2.2%. You have to go back a long way and you're not going to see very high rates. So your models are limited. And the second thing with the models is they're designed to change marginal changes. So you can maybe get a reliable indicator if a tariff went from 5% to 6 or 7%. But you look in the one case of one of the scenarios by the Bank of Canada where the average US tariff rate is 28%. Can your models analyze the effects of that? And I say, no, they can. And that's not a fault of the models. They weren't designed to that. And this comes back to the permanent scarring. If you look at the baseline tariff that the European Union accepted at 15% or Britain accepted at 10%, that's at least and probably more than the profit margin of anything they're likely to export. That might just be enough to completely shut down the exports. A really high tariff rate may permanently shut down Canadian steel, aluminum, automobile, the list goes on and on. So your model might say, yeah, your exports maybe are going to go down 5 or 10%, but the reality may be that that's enough to just completely wipe out the industry.
Well, we're recording this and discussing this live on July 31st, which is before the announcement on August 1st, which may or may not come. We don't know. But if there is a deal within days, let's say, and it's along the lines of the deal with Japan, you mentioned the EU, also the UK, so on. These are deals a little bit light on details, some big numbers flying around, a little bit of a pay to play situation in the US economy. if Canada gets something more short term, and then this idea that we'll renegotiate, as we're meant to by 2026, NAFTA, CUSMA, whatever you want to call it, a free trade deal, is that good? Get something quick, and then there's something a little bit longer dated?
I think it's just worrying and then worrying and then more worrying on top of that. The first point is I'm amazed at the reaction to agreements like we've been seeing so far that have these baseline tariffs or 10 or 15%, and in some cases even higher. It's that phenomenon of normalization of the abnormal. And it's a sigh of relief. Well, it's not 25, it's not 35, it's 50, it's just 10 or 15. That is your profit margin. I'm sorry, that may shut all those industries out. I sure hope we don't see Canada signing an agreement like that, because I think that would be really dire. Secondly, we have all kinds of special procedures going on, some of them playing out already. Softwood lumber, we're always warned something's coming on pharmaceutical. The list goes on and on. And then, as you indicated, 2026 starts the review process of the Canada, US, Mexico. I can't see the likelihood, given the mindset of the U.S., that that's going to get renewed in anything like the terms we've got right now. So,
Which is free
whatever
trade,
happens,
right? It's
yeah,
actually free
yeah,
trade.
it's kind of interesting because the tag, Trump always chickens out, he's unpredictable and stuff, but it's been constantly clear. He doesn't want free trade. He wants a baseline. You have to pay a price to enter the U.S. market. We cannot, in most industries, afford to pay very much. Our profit margins simply aren't big enough to do that. So we got this whole series. And plus, even if he signs an agreement, he could break it the very next day. There's no guarantee of that. Everything he's doing right now is probably going to be declared illegal, that he didn't have the authority to levy these tariffs in the first place.
When you see, so let's go to the Fed for a second. We'll come back to tariffs. I think there'll be some questions coming in on that. So the Fed yesterday also didn't move. We saw the PCE come out today, so it's a measure of inflation, trending higher. And the Fed also didn't move because they felt there was uncertainty and there was the possibility of inflation. Canada also has the possibility of inflation, according to Tiff Macklin. There's concerns there. Let's just sort of tackle the central bank place in the world right now in the North American context of where economies go from here. To what extent are they running the ship or the show? It doesn't seem like they are at all, actually.
Well, I think we have to constantly remind ourselves that the central banks only have a loose control. I shouldn't even use the word control, a loose influence on bond yields. And that's the irony of Trump wanting them to push down their policy rate to 1% because he wants a lower cost of borrowing for the federal government. Well, the U.S. Debt is almost all long-term, very long-term. And if the Federal Reserve Board pushed down the short-term interest rates, the long-term interest rates will probably go up. Most Canadians have a mortgage, have something like a 5-year term. That runs off the 5-year bond yield. The central bank rate doesn't have a great influence on that. That comes from expectations of economic performance and expectations of inflation. So the bank is actually indirectly doing something to keep those longer term interest rates down as it is. But the Federal Reserve Board faces the same problem in Canada. Despite the tariff and some weak points in the U.S. economy, in aggregate, the U.S. economy is still performing decently, and their underlying inflation is unacceptably high for the Federal Reserve.
Let me pick up on what you said there. So having treasuries, for instance, at lower rates, which ultimately is sort of the goal, I guess you could say, it seems, for the administration right now. Would that be attractive to Canada buying treasuries, to Canadians buying treasuries, to the Canadian government buying treasuries? Would there be a business case there for Canada to have a better investment there?
Well, we always talk about the weak productivity performance in Canada, and certainly if we look at it in terms of labor productivity, our number one problem is weak business investment. It's been weak for a long time, but it just really went south after 2015. It's not the magic bullet by any means, but if we did have lower, longer term interest rates, we would have more borrowing, we would have more business investment. But the way to get lower, longer term interest rates is to grind in an expectation of low, stable inflation. And you don't get that when your underlying inflation pressures are sitting at 3%. Now, that being said, almost all the bond yields in Canada are just barely over 3%. And people say, well, that's high. They were 1.8% a couple of years ago. And they keep telling them, like, we have records in Europe of interest rates over 1,000 years. You don't typically get bond yields less than 2%. these are, by any historical standards, these are fairly low bond yields.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
So it's interesting. I mean, there's a question yesterday again in the press conference asking about, because you hear about these structures of sort of the pay to play story within the U.S. economy. Like what will it cost to make sure you have access to the U.S. economy? The Japan deal is a perfect example of that. $500 billion investment in order to sort of have access and lower tariffs and so on. Do you see something similar, a pay to play scheme of some sort, which could involve buying treasuries, for instance?
It may, but like in a lot of these other countries, first of all these countries do a lot of investments in the United States at any rate. So
Yeah.
they're probably just going to count. And it's really interesting, the European Union, because you have to look at that. The European Union, who signed the agreement on behalf of their members, has no ability to force investments from their member countries. So I don't know how it plays. They can't turn and say, France, you got to do this. Spain, you got to do this. They have no authority to do that. So I really don't think anything other than a continuation of a status quo. People have always bought weapons and Boeing planes from them. Will they buy more? Probably not. Canada has always invested a fair bit in the United States economy and probably will continue to do, particularly, again, coming back to our productivity, particularly in the higher technology space, because, we're born to multiply everything by 10 to 1 when it comes to the United States. But when it comes to high technology, unfortunately, it's a little bit more skewed in the U.S. favor. So, and which is why we have the service deficit with the United States, which Trump always ignores. We have the merchandise deficit, but the United States has a surplus on services at the higher value end. And we will probably continue to have that.
Yeah, I mean, I think I was just looking at a stat that was showing up. This is from the Canadian Chamber of Business Data Lab, I think, but just talking about the trade surplus and energy and various minerals that go to the U.S. and form the discussion around that surplus/deficit story there. I mean, what do you think ultimately a tariff deal, because Canada is in a different position to the EU and the UK and so on, we're right next door to the US. What do you think is either being negotiated? I'm asking you to look into a crystal ball here, but you're well informed. We're hoping that you have some answers. What do you think the U.S. wants?
Well, that is very clear. They want production to come back domestically. He's been very clear. He sees no case to have any cars made in Canada. Why wouldn't Canadians just buy U.S. cars? So that doesn't give one a great deal of promise. He has said for security reasons, he wants steel and aluminum to be made in the United States. So there's no consideration given. An alternative view would be, because we buy so much from the United States, it's in the U.S. interest to have a thriving Canadian economy. That's a rationale. And that's what has worked to the American favor historically. Yes, they've had this merchandise trade deficit, but they've had a surplus in services, and they've had inflow of foreign capital, which has allowed them to buy assets around the rest of the world. The only problem with that model, well, is raise their national wealth. It has been skewed to wealthier people. And yes, it has been a hard deal for manufacturing workers, for example. He wants to turn that around. But, as we were talking about before the show, we have all kinds of examples when they put on the big tariffs on washing machines. And they actually started to make washing machines again in the United States. And it's been calculated the cost per job was $780,000 per job per year. So you can do it, but the U.S. consumer paid for all of that.
Well, so this is the lack of efficiency. I mean, Tiff Macklin's talking about it from the Canadian side and how that'll work, but that's an example of how it's less efficient to be less globalized in your trade aspirations for the U.S. How is Canada, in your mind, to fill in sort of the next couple of years? Because it looks like we do have to pivot to other partners. or there will be some sort of deal, but it's no longer going to be a free trade deal, or at least that's what it looks like at the moment. This will take a while, right?
It seemed like a very good model when Canada started out. The United States was so much more advanced. It's not just their 10-1. I mean, they were a country before we were. They had a big population. They had an advanced economy long before we did it. You got this big, powerful, rich neighbor, as the saying would go. They'll buy virtually anything right there. Low transportation costs, same language, similar customs, etc. It makes sense to establish almost a unilateral trading relationships. 76% of our merchandise exports going to the United States. That seemed to work out very well historically. Even if Trump tomorrow said, sorry, I was just joking, I'm not interested in this tariffs, that trust has been broken. The lesson has surely been taken. We can't have that model anymore. We have to diversify, but it's easier said than done. Europe and others have already got their sources. They already make a lot of things. China, yeah, for sure. It's a huge economy, but it's a tough partner and it plays unfairly. It subsidizes the things like crazy. They subsidize the steels. There are massive subsidies on their EV car production. The list goes on. And if they don't like something you're doing, they claim there's some kind of infestation in your grain, and all of a sudden you're shut out of their market. So it's not going to be easy, but we have to do it. And of course, here's the broken record. We have to dramatically increase our productivity, or we're not going to enter any new markets and be competitive with them.
Well, that takes investment. What would lower interest rates in Canada mean for what the government has to invest in this country?
Well, lower interest rates would help, but it's not the only thing. I found it very interesting. A couple of days before Michael Sabia was named as the new clerk of the Privy Council office, he gave a speech saying that there was an ambition deficit in Canada. Of course, when we heard him say that, we didn't know that he was about to be clerk. I suspect he knew, but I think there's something to that. We seem to be more averse to risk in Canada. Sometimes in the United States, it goes too extreme. You go bankrupt, and the next day you've got 10 credit cards or bank loans being offered to you, and that's just silly. It encourages the bad behavior. But they do seem to be more aggressive. They do seem to have more than the usual 10-1 venture capital. We actually create firms at a more rapid pace. They actually grow faster initially in Canada, but then they stop growing and they sell out when they get to a fairly low level of sales, about 500,000, which coincidentally is typically the limit where you lose the small business lower tax rate. But that speaks to a mindset. Why do we give favorable tax treatment in both the corporate income tax rate and things like the scientific research experimental tax credit to small firms? Small firms are great. We want to have them. We want to continue to have them grow, but we want to continue to have them grow. Why do we want to do something that sort of protects them to stay small? So that's a mindset that I think we need to change.
Well, that's interesting because a number of, I think it's been said before on Fidelity Connects by various Fidelity portfolio managers and so on, that those companies that currently are not working with the compliance sort of umbrella over them for the CUSMA, USMCA, are often smaller companies that chose to sort of eat the tariffs because the regulatory burden was too heavy to comply with CUSMA or USMCA, whatever you want to call it. And I think it's been talked about many times, even by Mark Carney, that they're quickly coming around to seeing the benefits to be sort of under this umbrella of compliance and so on. But for small companies, one of the reasons that they can't make it is compliance for sure across all kinds of levels, but particularly selling to the U.S. and being compliant with the USMCA or whatever you want to call it.
Yeah, you get a number of tiers of preferential treatment if you stay small in Canada. You get an almost zero corporate tax rate. You get higher tax credits for research and development, and very often you get a looser regulatory regime if you're small. And it's like the marginal cost rises. But that speaks to a mindset. And why does that mindset exist? That has to change. Things like how silly it is to try to establish free trade around the world, and we don't have free trade within Canada. and we got blah, 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 blah. We're going to do something about that. And a big deal about the federal government is doing, but the federal government has limited options. They don't control most of the internal trade. And yes, you've got breakthroughs, BC and Alberta got a deal on exchange of wine, but that's small stuff. There's still all kinds of examples. And you see some cases where they're already walking back on their intentions, but that's insane. To make this change to a new economic and fiscal model, we have to drop all of these things we've done before. And we have to be a lot more less protective of the agricultural sector, for example. But then we have to call out the US where we need to call out the US. They heavily subsidize their dairy. They're all over us for subsidizing our dairy. Excuse me. Like it's estimated as much as 25% of the dairy farming revenue comes in the United States through the form of subsidies. So we have to go after that if they're going after ours.
So there's a question on supply management I want to ask you in a sec, but we actually did see a few deals between provinces to, establish a footing for energy corridors. There's some discussion there. There's some movement there. Presumably what the federal government can do is spend. And once these agreements are in place across the country, that they can pour money into it in the forms of making sure productivity and AI gets built, gets implemented, gets a trained workforce up and running. There's a question here about thoughts on AI and productivity. I mean, maybe we'll just add it to what you just said about, the regulatory structure has to be there across the country, but what the federal government can do is spend.
It can, but we do have to worry that a lot of the spending they're talking about is not going to be climate friendly. We do seem right around the world, and Canada seems to be falling down on our steadfast adherence to trying to get lower emissions. So I would want to see that careful. It was pointed out recently, China is becoming a global leader in clean growth. Canada should be evolving into that. It's not just, yes, we could make more of our natural resources, but we could make more of a higher value added space. And the United States is moving out of the clean economic space. Why don't we fill up that gap and be a leader globally in that? We have the resources, we have the technology to do it.
Ontario's built all this infrastructure for EVs, and in theory, there are lots of minerals in the Ring of Fire that if agreements are made, and there's a lot of progress there, can sort of feed into that supply chain. I mean, actually, you suggested this on a webcast with us, I don't know, a few months ago, that maybe Ontario could be the EV spot in North America, or one of them, at least be competitive.
Yeah. And it goes through different industries. As Canadians, we think of Texas as being the fossil fuel capital in the United States, but they're also the leader in renewable energy. Right. Who would have thought that? But on the other hand, Alberta was growing a very substantial renewable energy and then froze all new applications for renewable power. That doesn't make any sense.
Do you think there's a sense that we have to sell the fossil fuels, get rolling, get moving, and then switch?
I think people have said tomorrow is the end of fossil fuels. No, it's the day after tomorrow. It's the day after, they've been steadfastly wrong. Obviously, they're not going to disappear as fast as people have thought, but there is an end to it. And other countries are moving away for it. So we have to be prepared for that day. And we do have the resources and the technology to do that. And in the meantime, obviously, we can make substantial progress in cleaning up our production of fossil fuels. So we have a potential win-win scenario here, but we have to think differently than we've thought before. It can't just be we go back to the previous economic model and change it at the margin. We need to change fiscally as well. I mean, not relative to the United States, but relative to almost all other countries, we rely far too heavily on personal and corporate income taxes. And we should using indirect taxes. They have a lower economic cost and they don't damp the incentives to work, save, and invest.
Oh, good. I love getting into the tax discussion. Okay. All right. So corporate taxes, certainly we have to compete with what the US has just passed in the One Big Beautiful Bill. Are we going to drop corporate taxes?
Well, to Canada's credit, beginning in the 2000 budget, we started to lower, in 1999, with the surtax, the federal corporate income tax rate was 28.4%, and we dropped it to 15. Bravo, kudos to that. That was a liberal government and a conservative government that did that. We created a tax advantage. Then Trump came with the so-called tax reform, which really bugs me to call it reform, because all he did is lower the rate. He kept all their silly preferences in place, and other countries responded, and we lost the advantage. So we're the small country. we have the disadvantage of not having the economies of scale. We need to have a corporate tax advantage. We've lost it. We need to rebuild that.
Is supply management going to survive in Canada?
That's a very difficult one to say because the Parliament passed the private members bill that it couldn't be offered. Now there's a legal interpretation. There's a way around that. I suspect it won't. But I sure hope that they get a quid pro quo of an opening up of the U.S. market, and when it comes to Europe, get an opening up of that, because they're the height of hypocrisy of criticizing us for being closed when they're heavily subsidizing and closing their own.
Let me ask you about the Fed. There were two dissenters yesterday in the decision. Question about whether the Fed, one, just has more voices there, more democratic even, is a discussion. What do you think about that? Is it good? Is it bad? Is it just not the center show anymore because we're not in sort of such a tight interest rate story right now than we have been? What do you think about the dissenters?
I think dissent is great if it's around real issues. I think dissent is going to be bad if they're just acting in their political affiliation. And I think to the degree that is, and I have great fear that after Powell's term is over, we're going to get a political appointment that has no experience and will just do what the White House, i.e. Trump, wants to do. So I think that's bad. This time, at least superficially, they present it as an issue of substance, and it's not over the tariffs per se. It's about the impact of the tariffs. The two dissenters are putting a ban that's going to be a one-time price hit. So it'll raise the level of prices, but won't have an ongoing effect on inflation. And the people who voted to keep the interest rates flat said, well, wait a minute. No, the price level is going to go up, but then people are going to try to recapture that through wage gains, and that's going to have a spiral effect, and it's too early to tell. That's a legitimate debate. Again, because we don't have a lot of historical experience, how big tariff increases are going to flow through. You can argue either side of that. At least in this case, they go with a majority vote. So, given their economy is still holding up and underlying inflation is still strong, I think keeping the rates level is a reasonable decision on both the Bank of Canada and the Federal Reserve Board. If and when the economy is weakened, they'll lower the rate.
Right. Okay. Which, yeah, if and when it weakens, yeah, that's not good. What do you think about the scarier and the heavier the headlines from the administration over the course of the next, about Canada specifically? Does that mean we're getting closer to a deal?
Well, I guess from the U.S. perspective, if Canada, their press secretary used the term caves before, if Canada caves the way the other countries are doing, particularly the UK and Europe, I suspect a trade deal is inevitable and for the offering for Canada if it wants it. But it'll be a very significant baseline tariff with yet higher rates on certain products. And the question is, do we want that? And what's the alternative? If the alternative is we get smacked something like 35%, then you're making a bet that will ultimately hurt the American economy so badly they'll relent. But that's a risky bet. It's not an easy position to be in whatsoever. But it's hard to sit here right today and think that in a couple of days we're going to see an agreement that pleases us.
Right. Okay. We'll leave it there.
I said, this model that it's in the U.S. interest to have a vibrant Canadian economy has no weight in the U.S. We don't care about the Canadian economy, and the reality is, if the Canadian economy gets impoverished, it's not going to be buying a lot of stuff from the U.S.
Okay. So what do we do? What's the bright side to leave it on? That the economy is still okay right now? It's resilient for now.
It's okay, and we can't lose our focus on building a new economic and fiscal model, less reliant on the U.S. with a lot higher productivity.
Fantastic. Don, I want to thank you very much for joining us here today on Fidelity Connects on Drummond. We'll see you soon.
Thank you. Bye.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. Well, on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.